Hello and welcome to the download. I'm your host, Dave Richardson, and it is a sweltering Tuesdays here in Toronto. Stu, how are you doing in the hot weather?
Not bad, not bad. As long as the air conditioning's going, I'm okay. But my hair, I can't complain about my hair getting puffy because I think you might feel the same every so often. But humidity, yeah, not my
Yeah,
favorite.
no, yeah, I am struggling with the longer hair in the summer. It does make it challenging. But let me tell you about who was putting on the real heat. Last week, I was at a conference with Stu. Stu's up on stage. Didn't even know this, and he's interviewing a really senior person in the firm. And Stu, it was like Mike Wallace, like vintage 60 Minutes. Stu is just grilling this senior person with all these tough questions. And then I believe you referred to his background as deep and dense. Did you get away with that? I'm glad to see you're still employed.
Yeah, well, I learned from the best, Dave. So
Oh, yeah, that's right. So we're gonna put on this episode of the download, we're gonna put Kedwell, global head of equities, head of global equities at RBC Global Asset Management. We're going to put his head in a vice and we're going to hit him with all the hard questions. But because actually, I mean, there are some hard questions coming up. I guess that's a good way to position it. A lot of hard questions for companies across the whole spectrum in terms of their earnings. So we moved into July now. We've had a fantastic run up in markets since the bottom of the tariff scare. And now we're sitting at all-time highs almost across the board in major markets around the world. But now it's put up or shut up time for companies because they've got to come through with the earnings that markets are expecting, or
the guillotine, no.
or
No, you're bang on. Like I think we've talked about it in the past where, markets that are in motion often tend to stay in motion until they're given something to think about. And so we've seen a lot of headline noise, tariffs and what have you. But generally speaking, markets have just continued to kind of gravitate higher. And now when you get into the actual earnings season, the risk is, the good earnings aren't met with further share price reaction because that, in fact, has been the expectation that has been put in place. And we're just very early into that. But we've had a couple of financial companies, U.S. financial companies today, where the numbers were reasonable. In many cases, some were quite good, but the reaction has been a little more sanguine in response to it. So, the stock market is when you buy a stock, you're buying a set of assumptions
yeah,
about the future, and if the share price is going up, the assumptions about the future are better, and then you have to live up to those assumptions when you actually report your earnings. And this is all a bit more short term than we normally discuss. Earnings. Have done a very almost rhythmic job over long periods of time at growing at a 6 or 7%. Throughout time, but in the short periods, you can get earnings that are growing above that. Yet the stock market seems kind of unimpressed at the time. And when we've had a big run like we've had right now, where markets are back to highs, valuations are back near levels that were also consistent with past highs. You just have to worry about that a little bit more in the short term than you otherwise would.
yeah. I mean, it's like your kids getting a report card, right? Like, so you're watching them through the school year, and you're going, hey, they seem to be having a little bit too much fun. Maybe they're not doing enough homework, but we're not sure. Hey, how check in with them. How are things going? You trust your kids. They say, oh yeah, I don't know, things are going great, and they bump into some. Oh, you have such nice kids. They're so smart. Everything's good. So your expectations are high, and then boom, right there on a piece of paper, you see this is what actually happened, and then you go, oh, wait a minute, maybe I was a little bit too loose on things. Maybe I need to tighten some things up. Maybe I've given them a little bit too much credit, or maybe I haven't given them enough credit. And but when the expectations are super high, whenever I don't see A's across the board with that report card, And that's where my expectations are. It's not hard for companies to disappoint, and that's when, when we have a run up like this, where you've got to be somewhat cautious as an investor, and yet we're seeing a lot of investor behavior in some parts of the market that seems to be throwing all caution to the wind.
Yeah, when you start to see, like it's one thing to see like a good quality company that maybe has a slightly elevated valuation and it's a little bit ahead of itself, and you look at those companies and you say, well, the earnings are going to grow over time, and they can more than kind of compensate for maybe a short term elevation in that valuation. When you start to see other things flying 20-30% in a day, we've seen some new issuance activity where you get very strong responses. We're seeing some action in some of the crypto markets that have been kind of rebirthed,
Yeah,
and it's not like Bitcoin's been strong. It's not just Bitcoin, it's some of the other aspects to it. When you see price movement like that, it is unlikely to be just fundamentals. It's a function of money flow. It's a function of and speculation sounds like it's a dangerous activity, but when you're kind of buying something with the idea of selling it quickly at a profit, or participating in something, that's kind of what that behavior is, and it speaks to like a risk on mood everywhere. And when you see it, whether or not you're participating it directly, you have to kind of take note of it and say, investors are getting a little amped up. They're a little excited at the current moment, and it doesn't really get in the way of a long term plan, but it is the type of thing where you definitely want to take note of it.
so Stu, do you ever get involved in that? Do you just kind of say like, I see some stuff. I've got some cash in the portfolio, and hey, I can't explain why, but the thing keeps going up every day. I've got my FOMO, just like anybody else, and maybe I'll just throw some cash in there for a little 20% run for the day, and then pull it back out, and all caution again to the wind, and I'll just add a little bit on the edges for my portfolio. Is that anything that you or your colleagues would do?
Well, it's certainly not anything that's happening inside of the funds.
Yeah,
And at a personal level, I unfortunately I've got more scars than successes.
yeah,
So I tend to not really get involved. Although there certainly was a time in my life when I was trying to harness those
yeah,
those
yeah,
uh, those gains, and we've talked about a lot about that before about. Um, if you're going to get size the positions properly, have it as a percentage of your portfolio that if something negative takes place, you live to see another day. All those types of things. That's just kind of good financial planning and construction. And then I think the other thing too is when you get into these situations, like I scroll through Twitter. There's a tremendous amount of technical analysis commentary
yeah,
on Twitter, and it normally drives a lot of the movement in some of these assets. Like in technical analysis, is like going through moving averages or trading through certain levels. If it trades through this level, it might go to this next level. Um, that type of commentary, that's certainly not fundamentally driven, right? But as I'm often reminded, people will bet on horses, so
yeah.
people are going to bet. They're going to behave in all certain ways, and some are very good at it. So no harm, no foul. But uh, once you get into those types of positions, you're using a very different toolkit than attaching yourself to long-term earnings growth and long-term compounding.
Yeah, and I think one of the reasons we bring it up is, both of us were young at one point. Stu, you referenced that you were younger more recently than me, and it's almost part of an education to some extent to go in and try some different things, particularly if you're interested in this area. I learned a lot from what I did as an investor in the younger days, and as you suggest, quite a bit of it was how to deal with loss. as opposed to any great success, because we're both still working today. But I think for the many young listeners that we have, but also for listeners who have kids or grandchildren who are dabbling in some of this, it's really important to recognize that these are very, very unusual periods when you see this level of speculation in markets in certain areas, and it is something that can do some real damage if you don't know what you're doing, or as you say, you're not betting, and it almost is betting when you get to this point. You're not sizing your bets properly.
Yeah, I think that's kind of bang on, and the there's all sorts, like there's participating in daily price movement. There's a kind of an investing mentality where you sit there and say, I think that there's reasonable likelihood that something's going to take place, that investment is going to switch, and these sectors are going to start to receive more attention, but I don't know exactly when that might happen. So buying that and waiting, where you're making something that you have a high degree of confidence in, that is a kind of a tried and true way of making money over long periods of time. Waking up and looking at something and saying, well, it went up quite a bit yesterday, so I think that will persist, is always possible. And momentum does tend to run for a while, but it's also can be more consequential when that momentum ends.
Yeah, if there's if you're investing is a long-term process. Speculating and gambling again are shorter term. And look, there's people who are very, very good at it. They're few and far between, and they're generally paid a lot of money because of that particular expertise. Oftentimes, people who are trying this without that specific expertise are more or less, on the surfboard riding the wave, until the wave crashes, and if they don't know what they're doing, they fall down and hit their head. But it's really something where you at some point that momentum shifts, and if you're caught, it can do some real damage. So that's just really again, if you own something that's quality, and it's quality, even if it does suffer through a correction with the rest of the market, that there's something there that you understand. And again, that's particularly what you and your team do. You work to understand, and in detail, on many different levels, what you're actually investing in. And if there's quality there, it's going to be back at some point. If it's just something that's a product of speculation or rumor, and there's really nothing there, and at some point there is really nothing there, that's when you see investors really get hurt.
Yeah, like, it's also a matter of saying, like, how wide is the path
Yeah.
required for my success? And in any investment, no matter how expensive, no matter what the asset class is, there is always a pathway to success. So you don't want to rob people of that notion, but really what you're looking for is how wide is that pathway for success? Like, how many ways can I win? And when assets go up a lot in a short period of time, and the underlying notion might be kind of in its infancy, like with a lot of potential, but in its infancy, then the price reaction is actually narrowing the pathway. And it doesn't mean it won't be successful, but it's narrowing the
Yeah, yeah,
pathway.
yeah, yeah.
And I think that's what investors need to um, kind of acknowledge to themselves, just as they're entering this. And that's where you get into position sizing and all sorts of things that are all well worth discussion.
So Stu, we've had a little bit of a tick up again in tariff noise just over the last couple of weeks, for Canada. Just an all of a sudden announcement that a 35% tariff being applied across the board. We saw the thing with the digital services tax. I think we talked about that. Are you seeing companies do a good job of managing around the tariff still, or do you see anything going on around the tariffs that's a reflection of just the kind of challenges that the tariffs cause?
Yeah, it's a great point. I think a couple of noteworthy, like we've had a lot of discussions with companies, chief risk officers of banks, all sorts of things. The one positive has been the time since the very first announcement, right? So businesses are very rational.
Yeah,
They got the shot across the bow earlier this year, and they've had some time to adjust things, right? So whether or not it's bringing down inventory, reworking some of their affairs, blah 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 blah, that stuff has certainly taken place. The level of uncertainty remains quite high, so there hasn't, it has definitely put a pause on some new investment. And the other thing too, that as investors that might find this analogy interesting, is just how easy it is, or how difficult it is to draw an easy conclusion. So we were having a meeting with one chief risk officer, and he said, you go see a business and you're like, oh, this business will be impacted by the tariffs, but then it turns out that their contracts have the clauses that say if there's tariffs, it just gets passed through. So it's on your worry list, but then you end up kind of taking it off. Versus there's some other domestic businesses where you'd say, well, they're not impacted, but they might have a reference price that dictates how their goods are bought and sold, and that reference price might be in U.S. dollars and might be impacted by
yeah,
tariffs, right? Like so there's no one size fits all way to do like a broad sweeping analysis across all these industries. Our primary concern um, is that the economic impact. The good reminder is that the Canadian economy is not quite the same as the Canadian stock market. There's different exposures in the stock market than there is in the direct economy. And then the second thing is that you do worry about some of the bank's loan books, but they've also all set aside a fair amount of reserves. So, could there be some slightly incremental reserving? Yes, but they've also had to kind of adjust along the way, for some of what's in front of us. So, so those are kind of the two primary things that we're thinking about on that front.
yeah. I was at a birthday party a couple weeks ago, and there was a tariff expert, tariff tax and accounting expert, and I'm talking to him, and I'm like, hey, just ask the question that you know the answer to. He's like, hey, how's business? He's like, great, it's awesome, it's amazing. And I said, but it's busy, and the pluses and minuses of it. And I said, oh, it's a really nice jacket you're wearing. Oh yeah, it's brand new. And somebody's doing. There's always somebody doing
Yeah.
well off of this. And as you say, tariffs are complex, and they're hard, but good management teams figure out a way around it.
100%. Like I think that's we've wrapped a lot into today's discussion, but when you're investing in something with the intent on selling it, you're not focused on a lot of these things. If you invested in something for owning it a long period of time, then you want to marry yourself with management teams that know how to adapt the business and get in there and play with the levers. So, if you go back to that runway, you already start with a bunch of businesses where you think the runway is pretty wide. And what management's actually doing is they're widening it even further on your behalf,
Yeah,
because
yeah.
they're busy in the back, kind of adjusting the sails as the winds shift a little bit. And that is kind of an additional lever that the longer term investor gets in those instances.
And then on the inflation front, which is one of the concerns out of the tariffs, we had the CPI number, Consumer Price Index number in the U.S., which is one of the key measures of inflation in the U.S. economy. It came in. It was up from the previous month, but kind of in line with expectations. Didn't seem to have a big impact on markets. So we still really haven't seen, I think, the dramatic uh, upward pressure on inflation that some are anticipating, or was this maybe the first sign that you're starting to see it flow through in the economy?
Um, maybe a little bit, but like we still haven't. We have, a lot of these trade deals have been getting pushed out, and deadlines are being pushed out. So it's hard to conclude that this inflation environment is the one that will persist. Although I would note, even if we do get a bump from tariffs, it's often just kind of one time ish in nature. Um, I think the tariffs, the CPI, the bond market. There's a whole complex set of discussion points there around the fiscal deficit, inflation, the Fed, it's almost a podcast in and of itself
Yeah, yeah.
on all sorts of things.
Yeah, well, we're gonna get one of the Erics on to help us out with that. Stu, anything else you're seeing in the market that's of particular note, or have we done a pretty good job covering the really the most significant thing, which is I guess the earnings coming up, and then highlighting that expectations are high.
Yep.
So, and maybe an investment strategy in an environment like this that you could recommend.
Well, yeah, there's no question. Dollar cost averaging is very very worthwhile in this environment. Just before I get to that, though, I'll just step back. I think inside of the market, uh, the bill from the United States gives a lot of benefits to immediate capital investment. The consumer looks to
Yeah,
kind of be okay.
yeah,
So those areas are stronger. Some of the traditional areas like consumer staples are a little bit weaker as those revenue lines face some pressures. So it's still sector by sector. On the dollar cost averaging front, even when we tend to kind of power through with a strategy like that. Like, sometimes you're
yeah.
buying at great prices, sometimes they're a little bit more elevated. But either way, you're kind of attaching yourself to that longer term earnings growth. So, we tend to just power through with things like that.
Do you ever look at that kind of seasonality, because there's a lot of
Yep.
historical reference points where the summer is it's a downtime for a lot of people, just period. This is when you go on vacation with the family, and but do you see that in markets a little bit?
Yes, you do. Often, seasonal high points come right around the podcast that we're doing right now. They tend to kind of come in the middle of middle of the end of July into August, and then late August and September can sometimes be a little bit tougher on markets. And then as you get into October, you tend to find your footing rather, and that seasonality has played out enough times that it's noteworthy. And so we'll see. I think that's we would marry that message with some of the elevated expectations that might be presenting themselves at the same time as seasonality has an impact is also probably noteworthy.
Yeah, and so again, it's not a case of you need to abandon your strategy. The dollar cost averaging is where you can sit there, and if you're if you're putting new money in, it actually allows you to kind of cheer for the market to go down while you're sitting on the deck, casting a fishing line, or sun tanning, and then get back to the serious stuff in the fall, and hopefully get a rebound. So this is where dollar cost averaging kind of fits just in. And if the market keeps going, because it doesn't always work out that way, right? Then you're fine as well.
That's bang on, Dave.
Oh, bang on! Wow, I got a bang on. Well, my experience is deep and dense.
Yeah.
Anyway, Stu, thanks for catching up. We covered a lot of ground today. Lot of wisdom. Another thing, just Stu, I had the opportunity. Stu and I were doing some what we call it, career coaching, or
Yeah.
I guess, and I was pretty much useless, but Stu was sharing wisdom with these young people. I wish I'm gonna have to bring them home and give my kids get them to give my kids a hand, because I'm probably not doing a good enough job. Stu was 100% wisdom. It was pretty impressive to watch, just like listening to you on this podcast.
Well, that's very kind, Dave. So thank you for that.
All right, take the rest of the summer off, and but we won't. We'll be back next week. Thanks again. See you on the next episode of Tuesdays.
See you, Dave. Thank you.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.